Andy, welcome back to F.A.C.E. It's a great time to have you. How have you been, buddy?
I've been great, Dale. How are you?
Okay, so I have to ask you, Andy, have you been converted? Is this a new bull market?
Absolutely not. Have not been converted.
All right, good. I was hoping you didn't have a bullish bar mitzvah and and that you flipped. Bears taking a lot of heat, even though we're not always short, but we're always looking for opportunities on both sides of the market. So you have some visuals to support your view as to
Um,
why you're not bullish?
I don't.
Okay, then
That's not my thing.
okay, then I'll move around. So tell me what's top of mind for you in the last say week or so. We had some harmonic patterns that topped above was a Gartley above 4,400, and I have this wedge line that we're in an overthrow. And it looks to me like if we could get back under 43 and a half, that would be the first sign that potentially a top is in.
Sure. So last time we talked about 3 months ago, it was like the week after the banking
Yeah,
crisis.
yeah.
I was covering my short in SPX and selling
Uh,
bonds.
mhm.
And, that worked out. I ended up selling on the way up. So I'm short equities here and short bonds. And the combination of, in particular, short 2 years has more than offset the losses taken on short S&P. And, I think that what we've seen was that the banking crisis was a tempest in a teacup. There'll be more banks to fall, but my view at the time was that a few banks got over their skis, long duration, and were taken out for that reason. Um, and then since then, we've just had, we had the debt ceiling crisis. That was a wall of worry that resolved. Um, where we are today, we're at a interesting point. Your graph is interesting to me as well. Because we have an interesting quarter end setting up.
Okay.
In particular, there are large rebalancing flows. Rebalancing flows are, a portfolio that starts at 60/40 now being 65/38 or something like that, which requires some selling of equities, buying of bonds. And the vol targeters, the ones who lever up their portfolio when vol is down and delever their portfolio when vol is up, have by and large, you look at the VIX and have been by and large buying all the way down here as they've been
Yeah.
levering up their portfolio. And they may have some left to buy, but they've reached, from my work, they've reached their near maximum leverage. So their buying
Okay.
will probably be minimal for assets at quarter end. And so those are the big flows. And then, of course, there's this extremely large collar that expires on the 30th. That is a dealers are long options, long calls.
That
And
was a collar over 42 that we took out, right?
well, no, it's 43.20 is the strike.
Wasn't it
Um,
42 prior? 38,
uh,
42, or was it always 43.20?
well, every quarter it rolls.
I see. Okay.
And so this quarter, which was set on March 31st, rolled up the call strike to 43.20. And, we're right around there. And that's about $15 billion of dealer gamma long. And it should tend to, right now, the Charm and Vanna flows are negative, so they are not supportive. They are caps. And if we go higher here, which is possible, the delta goes up to 1, and then there's no more overhang of the collar delta. But if we go back down to 43.20s, I think we stick there for the rest of the month. So I think it's an
Okay.
important level. And I
Yeah,
would,
the writers wanted to, peg it. They want to peg it so both the puts and calls expire there, right?
right.
That's their
Well,
goal.
their hedging activity forces the market to that strike. And that in combination with the selling that we're likely to see from, traditional pension rebalance, should drive us lower in the near term. But that's very technical. I think the higher level point still remains that, Powell his testimony so far looks like it's hawkish in terms of the speech. He'll be higher for longer. I think it was a big deal that they raised at the last Fed meeting. They raised the terminal rate to 5.6. That was very high. Even my expectations, I'm very much higher for longer, and have been for almost a year now. The 560 number was pretty much, as hawkish as they could be. And that is still taking a long time for people to believe. Hikes are now out of cuts are now out of 2023, but you still have 150 basis points of cuts built in between that now and 2 years from now, and that's pretty. It's not taking the Fed at its word by any stretch of the imagination. So if they end up doing what they say, which so far they've been doing what they say for a year now, the
market challenges them every time.
Yep, and they just don't believe, and so the 2-year note is still.
What I don't believe?
Yeah, what's that?
The banking crisis is a tempest in a teapot. Whether or not there, as Yellen said, further consolidation, which is code to me, meaning failures. I look at the regional banks, and it's not complete. There are new lows coming, in my view, in the banks, and you can't just say it's only the small regionals. Take a look at Goldman. During this huge rally that we've had in the S&Ps, a blow-off parabolic in certain sectors like tech, semiconductors, the banks, the XLF, Goldman being, best of the breed, looked like all they managed was a bear market rally and they're headed lower. What's the problem? What's the problem with the banks?
You take 8 stocks out of the market, and you can't do that, but you take 8 stocks out of the market and the market doesn't look healthy at all. And banking.
But what about these banks though, Andy?
So coming back to KRE, I don't think KRE, you might be able to trade it, but I don't think it's investable to go long, because and I don't happen to have a bank failure idea as being the problem. I think they can, with the BTFP, the liquidity programs around, and the deposits are not fleeing as expected. It really is about solvency, and most of the rest of the banking system is solvent unless there's a borrower credit problem. And a lot of people are worried about CRE, and I get that. But you look at those stocks that are exposed to office space, and they've actually been doing pretty well. But the CRE is a potential credit event. But for now, the duration event is of higher long-term bond rates reducing their asset values, and the deposit flight is not a concern to me. But the bigger point is that these banks are going to be significantly, the regulation on these banks is going to be significantly increased in regards to the type of risks they can take. And
Paul told them to take the duration risk.
Yeah,
years ago, right? I don't know why he didn't tell them to liquidate or hedge. He knew what he was going to do to the banks. It almost seems intentional that they just want to have a handful of banks, their buddies, and actually they want to become the bank, and they want to be the treasury. Yeah, and that's what CBDC is all about.
The funny thing about that point, which I get that arc. The funny point about that point is that nobody else believes Powell. Why did these banks? You know, if there is some sort of intent that they were supposed to go, I honestly don't think they had a lot of choice. But you know, if you look at a good bank like M&T Bank that didn't buy long duration assets, and while Silicon Valley Bank did, I just don't know about that idea. But I do think consolidating of our banking system makes sense, and I think there's tremendous regulatory headwind on these companies, and then there's the credit risk. So I don't think you can buy regional banks at
well, here's the XLF, the big guys that were the beneficiaries of the flight capital, and their chart doesn't look much better than the regionals. Now, the magnitude of the drop was bigger in the regionals, but the form is the same. Drop and then consolidation. So what's wrong with the banks?
Yeah, I mean, I think they have a period of time in which the cost of their financing is going up relative to the return on their assets. But these big banks and their balance sheets are bloated with long-term treasuries. They've been selling treasuries for over a year now. And, those treasuries just don't earn what they need to earn. So there's going to have to be a balance sheet renovation that takes a couple of years. And so that's going to put long-term pressure on intermediate term pressure on bank earnings that have been, benefiting from very cheap deposits and fairly high interest on their assets. And that's shifting. And that it doesn't mean these banks go to zero. It means these banks are going to have earnings problems for a couple of years.
Okay, so here's TLT. We're going to come in a little bit lower here. Looks to me that, we're on the verge of turning pretty good. I know the 10 years up, but Andy, to me, I'm going to take the opposite side. I don't think we're going to break out here. It's a huge descending triangle, which implies a top. If you go back to classic stuff like Edwards and McGee. And back under 360, the 10-year will challenge 330 and eventually break down. Now, I think, and I want your comment on that, it's not because of what the Fed is going to do. I think it might be a risk-off event that gives us a pop in notes and bonds. What do you think?
Yeah, so my destination for the economy is a hard landing. That destination is being predicted by markets, including 10-year notes, but more so in the front end of the curve, for a long time, and they've been wrong. And so the question isn't whether there is going to be a hard landing, which will generate 10-year notes 3% or lower. It's a question of when. And in my view, that when is a lot longer than most people think. And so while a risk-off equity sell will be bullish for the long end of the curve, for sure, and that's a natural reaction for money flows. I think that the next way that the market plays out is the continued bear flattening that's been going on for a while now, which means more twos, tens inversion will continue, and that'll keep a floor under how low 10-year yields can go, because that negative carry is just extremely difficult for anyone who wants to go long 10 years. So I'm short 10 years. I've covered a lot of what my short was, but I'm very short fives and very short twos, and have no position in TLT. And I get the idea that TLT looks technically good, but I think that the way the market plays out is that equities stay supported longer than people expect, and ultimately the recession, the people that have been continuously calling for a recession for a long time, are surprised by positive data, and give up on their long-term bonds and are a bid for stocks, even though stocks are extremely rich in my view, and that causes a steepening from once we get a more full inversion, which is what I'm expecting short term, we get a re-steepening of the 10-year that takes it above 4, maybe 4.25, and TLT doesn't bottom until it's got certainly a 90 handle on it, but possibly low 90s. So I think that's the play that we end up with. So short term, bear, flattening; longer term, a steepening around a 2-year note that basically hits terminal rate, and then an equity sell off into a recessionary period where
you don't think is that put off till 2024?
There's a question about when it gets. So these things tend to get front run, but I don't expect a. So it's sometime in that period, but these things get front run. But right now you have just no supply in bonds, so because the Treasury's chosen to issue bills to refund its liquidity, and you got to have somebody sell the bonds for them to widen out here, and until China potentially has to sell to defend the yuan, which to me looks like it's heading to 7.5. Tokyo, Japan, the MOF and BOJ have to defend the yen to the extent it breaks to new weak levels, both of which I would think are inevitable, both the yuan and the yen, because of the weakness in their economies. And they become sellers of treasuries. That might generate some supply. And then by August, we get the Treasury's plan for issuance now the TGA will be rebuilt, but we'll start to see if they start issuing bonds in August. And I guess the last thing is I expect that the quantitative tightening done by the Fed, which is being done by runoff instead of market sales, is going to have to become market sales eventually. And when it does, that'll create a duration supply. So yeah, I'm thinking the second quarter will be, the rest of the summer will be about bear, flat, and further inverting. The September period will be higher long-term bond yields, and then toward the fourth quarter you start getting some recessionary impact on equities.
Where do you want to buy gold, Andy?
Yeah, so gold is going to suffer with real rates rising, particularly longer-term real rates rising. And so, right now, on Thursday I shorted gold, commodities, bonds, stocks, pretty much everything, every asset as part of my book. And so I'm not a buyer of gold until I start seeing a real rate top, or I could imagine in the 1850, 1870 range, maybe for a trade.
Okay. All right. And silver's been leading the way down. What else are you focused on? You have a dollar view? Rally?
I was very aggressively short the yen for about a month, and I took that off against both euro and USD. And I took both of those shorts off the day after I guess Friday, when the BOJ said, as I expected, that they're going to remain easy. I think I don't think you want to be long the yen here, but we had a big run on the short side, and so I wanted to take profits on that. The next currency that I'm looking at is US dollar, and I expect that will, and this is a little it's diversified relative to my other views, but I don't love the dollar. It's overowned, overbought by most institutional clients that I follow. Most institutions that I follow. And I'm looking to find a good short on that. I think the best short is going to be the euro. Go long euro USD. I'm looking to do that at around 108.
Okay, because that was pretty decisive. I like it, and the pullback compared to the other currencies, Andy, has been the shallowest. I mean, look, there's euro, cable's been weaker, and commodity currencies even worse.
Yeah, I mean, I
So,
think I think the USD is gonna weaken, and I think the euro is the best pair to do it with. I think also potentially your GBP is a decent long.
oh yeah, that
And,
turn, euro
and
pound turn
yeah, I'm looking at that. I
right
think
there.
the pound and the dollar to me are the most vulnerable currencies besides the Asian ones. And again, I think we're going to 150 on yen. Um, yen versus dollar, and I think we're going. We could see an August devaluation in the yuan.
Okay, hold on. You know what else is happening in August? I read, Rickards is saying they're launching their new gold-backed currency August 22nd.
Yeah, yeah.
What what do you
I,
think? It's a brick currency tied to gold.
yeah. I guess that would be ultimately bullish gold, but I think we have some work to do before you can do that.
Yeah. Okay. Just new event that I wasn't aware of till yesterday.
Yeah, I'll look
I
at it.
don't.
I haven't seen it either, but I'll look for it.
Okay. And I think we've covered the board. Anything else? Agricultural commodities. I'm not sure if you cover them or not,
I
but
don't play them, but we can talk about oil. Um,
okay.
I think
There's wheat.
I
Build a silo in your backyard, Andy, and
yeah.
fill
I
it
the
and fill it
problem
up.
problem for agricultural for me is I just can't forecast the weather very well.
Oh,
And
that's what you do every day.
right,
You're a financial weatherman.
right.
All right. So,
So crude, I think, is down on China being weaker than expected, and I think that's and the various cuts that are being done are just inadequate to deal with the reduced demand from non from Asia in particular.
yeah,
So I think we can see a real sell-off in crude. Though I don't have a position at the moment, I think it's an important part of the commodity complex and could drag other commodities down with it.
I would
Uh,
try it down here.
yeah, yeah.
Just
We had that big Pierre Aderode sell off on that one wick down in May.
yeah.
Um, I think you're going to have a sell off like that, and I think he's mostly out. So anyway, I think it's that is where it starts to get interesting to me as well.
Okay. I just want to show your site, buddy,
Thanks, man.
and where people could follow your work. Here you go. So,
Yep, on that site we have a bunch of my old damp spring reports for people who are who want to join our wait list. It's long, unfortunately, for but we constantly are putting out free explainers and work on damp spring at damp spring on Twitter. So feel free to join the wait list or contact me through Twitter.
yeah, and Andy's pretty prolific on Twitter. He posts a lot. So, at the minimum, follow him at Damped Spring. Here it is,
Yep.
and that's the name of his website as well. Andy is really tears things apart to look beneath the surface, and appreciate you being here again, my trading warrior brother. And good luck with your shorts and the S&Ps here. I
All
think we
right.
might
Yeah.
have a major top, Andy. No,
Yeah.
because all the bulls are giving up.
After June
That
30th, I'm gonna, see where we're at, but I think June
yeah,
30th is a magnet for now.
okay, and I think July's a very negative month.
Yep.
Okay,
Okay.
so like everything, time will tell. And thanks for your time today, buddy.
Thanks, Dale. Great to be here.
All right, Andy Constan, everybody, follow him at Damp Spring. And that's going to be a wrap. Hope you enjoyed Andy. I learned from him every time we talk. And you could join the team in about 19 minutes on the morning edge. That's going to be it. Remember, don't just count your pips, count your blessings. Adios, everyone. We'll see you tomorrow. I have Michelle Schneider with us. All right. Take it easy, everyone. Adios. Thanks again, Andy.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.